We are in an interesting inflection point in financial markets, and perhaps a big one on this week, where we have a lull in key economic news flow and the markets start to think about next steps in a more structural way. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And while we have this lull in event risk, of course, the biggest one for this week, the earnings report from NVIDIA, is already out of the way. And U.S. economic data is certainly quieter than it has been for a while. Never mind that there's no presidential election to think of anymore. We're going to look at what the markets have been doing for 2 months and see if we can't spy something of a reversal. Because what seems to be occurring here isn't so much that the narrative has changed. It isn't so much that we have a difference in the structure of what's going on or the economy has done something untoward. It's more so that speculative interest may have reached something of an exhaustion point in the story that was, starting to look at the story that will be, at least in the near term. So the first thing that we're going to do here is take a look at what has really defined the past 2 months. And unmistakably, what this admittedly very busy chart is showing you is a story that has a simple, straightforward, and really one-note implication. At the top are break-even rates. These are the bond market's measures of inflation expectations. The way that this works is when you take nominal interest rates, what you would normally see as quoted, 2-year rate, 3-year rate, 5-year rate, 10-year rate, whatever it is, and you compare that with the inflation-adjusted versions of the same maturity. So the 5-year TIPS yield, the 2-year TIPS yield compared with the 2-year Treasury note, the 5-year Treasury bond. And you look at those rates and you take the difference. And the difference, almost by definition, is that adjustment from nominal to real rates. And that gives you the quotient of inflation that is being baked into those maturities. These are called break-even rates, and that's what you see at the top here. What you can see with the naked eye is that since the beginning of September, they have been marching higher. More recently, they've started to idle. So the move in adjusting inflation expectations upward has seemingly reached a kind of leveling out. Against the backdrop of all of this, not surprisingly, what do you see from markets? In the yellow bars here is the yield curve, the 10 to 2-year spread. We can see it is steepening here. It remains negative since basically mid-year. Inflation, as you can see here, is falling. But once inflation starts to go higher, the yield curve starts to get positive. And of course, already since July, it is steepening until it flips into a positive setting. Yields are rising. On the bottom here, you have the actual nominal yields themselves. That's these three here. And you can see they follow in a familiar order. The 30-year is above the 10. The 10 is above the 2. And all of them in tandem, even as the curve is steepening, all of them are going higher. Now, that the curve is steepening is telling you that longer end rates, in this case, are rising faster than the front end. And that shouldn't be surprising considering this is September of this year, because, of course, what do we know about September? By then, the markets are completely convinced that the Fed is going to start cutting rates that month, and speculation increasingly favors a 50 basis point rate cut. So the markets aren't just looking for stimulus, they're looking for aggressive easing, for a dovish Fed. And when that move finally occurs mid-month here, what ends up happening is yields start going higher. Now, why would yields go higher if the Fed cuts by 50 basis points and offers a dovish view on future policy? Well, it's the rise in inflation expectations after that move, again, here's September, that explains it. Not surprisingly, the US dollar is rising with these yields. Because what the steepening of the curve and the higher rates and the higher dollar all tell you is the Fed is cutting rates in a way that the markets perceive, looking at the break-evens here, to be inflationary, because the US economy is not doing anything like falling apart or cooling or flirting with recession. By this point, by the time the Fed makes this move, the US economy actually looks like it is firming. Moreover, it looks like it's firming relative to others. Look at where we are already by late August. This is the City Economic Surprise Index. We look at this quite often. And what this basically measures is momentum in economic data outcomes relative to forecasts. This is not a growth indicator. This is a view into the market's speculative positioning relative to the flow of macro data. So what we see here from already late August, before we even get into September, is after a period where U.S. economic data in the green here was increasingly underwhelming relative to expectations, and by the time we get to May, already starting to disappoint relative to expectations. Hence, the markets fear that the Fed, in its resistance to cut earlier in the year, might actually miss recession, miss the boat, and have to scramble later. That, of course, helps to explain why yields were going down here and inflation was cooling. That's this period from, let's call it April, May into September, lower yields, lower inflation expectations, because as the market sees this happening with U.S. economic data, it says, oh, the Fed doesn't want to cut, they're going to miss the boat. They're going to have a recession on their hands and have to cut more aggressively. So lower yields, lower inflation. Now, by late August going into September, it's the flip side of the story. The U.S. economy is powering higher. And not only is it powering higher, but the momentum behind these upside data surprises is leaving everybody else in the dust. Look at this gap. Moreover, we can see the G10 catch-all is a little bit better than everything else because, of course, the U.S. is inside that average. The global numbers are next because, again, the U.S. is inside that average, though it is more dispersed because all of the economies are in it. And the weakest of the bunch is the emerging markets index, which is barely hugging zero at this point. Never mind actually showing the data out of those economies is starting to surprise higher, largely weighed down by ongoing anemic conditions in China, which really since the pandemic has been unable to get back on its feet and for 6 consecutive quarters now has experienced economy-wide deflation, where real GDP, that is GDP minus inflation, is going faster than GDP plus inflation, or nominal GDP, which of course implies if you take real GDP, add inflation, and end up with a lower number, inflation's negative, telling you the economy lacks demand. Because what do we know when the price for things is falling? What do we know when things are on discount? We know that things go on discount because nobody's buying them, and the price needs to go down to try to induce people. That's where we are in China. So what we're looking at here is this vast period of U.S. outperformance. Small wonder, really, that against this backdrop, what you end up with is expectations that there's going to be higher inflation because the Fed is cutting as this outperformance is occurring. And that higher inflation will mean the Fed will have less room to cut rates next year. And that the rate cut cycle in general is going to be shallower. So you get a steeper curve, you get a stronger dollar, you get higher yields. All of it lines up. And now the question becomes, well, has that story hit a wall? Have we fully repriced for all of those conclusions? We'll start with the bond market, which begins to tell the story. This is the long end of the curve, which you might expect to be reflective of where scope for future rate cuts lives. And here's that massive, massive adjustment. This is bonds going down, and so yields going higher. Not surprisingly, notice this is the beginning of September. This is the Fed meeting where they cut by 50 basis points. Yields go higher after that, not lower. They take out a longer-term up move here, this series of higher highs and higher lows. But notice, this has done next to nothing all of November. As a matter of fact, here is the U.S. election right here, this last big push to the downside. Not surprising because, of course, Donald Trump wins a resounding victory, and the policies that he's been talking about are inflationary. A sales tax on imports, which is what tariffs are, that's inflationary. That increases the price of goods for consumers. Deportation of migrants, that reduces the supply of labor, especially of cheap labor. That means the cost of labor goes up. So the cost of everything that takes labor goes up. That's inflationary. So not surprisingly, when you get that resounding Donald Trump win, yields shoot up. Markets are telling you that they think it's inflationary. This isn't an opinion. It isn't anybody's political bias. It's what the long bond says. But notice that by then, you've reached what is essentially a crescendo low in bonds or a crescendo high in yields. From here, you're stuck, and progress stalls. It is a similar story for the US dollar. This is the euro, the most liquid dollar counterpart, 6E futures. And you can see again, once the Fed issues its cut, yields start going higher, well, the dollar then goes higher. Because its yield advantage starts expanding relative to other economies. That the US economy is outperforming, of course, means that you're not getting interest rates in their differential with other economies moving in tandem. Those differentials are widening because most other economies are still in the market to cut. But the US economy is so much stronger and trending so much stronger at this point that these yield differentials widen to the dollar's advantage as US yields march higher. So the dollar strengthens, explosively so. At this point, we can see the euro is sitting at the low from March of 2023. We're not too far from a 2-year high on the dollar. And so here, again, over the past several days, standstill. Has anything changed here? Well, not really. We haven't had really any U.S. economic data to suggest that for some reason the story has changed. But rather, this peak right here is last week's speech from Fed Chair Jerome Powell. who comes out and acknowledges that maybe we don't need as many rate cuts because the economy is hotter. In other words, he acknowledges this, everything the markets have been doing for the past 2 months, endorses it, as it were. That takes speculative juice out of the story. If speculation has become reality, well, there's not a whole lot more to say. The price reflects the best known information. It's been discounted. So this stalls. Gold, which is a natural foil for both rates and for the dollar, has a bit of a strange ride here. You can see that in September, it actually keeps going higher. This is where the Fed occurs. And it keeps going higher, perhaps thanks to uncertainty linked to the election, because once the election occurs, gold rapidly closes the gap and comes right back to where it was when the Fed made its moves. And of course, by then, there's not much more to squeeze. It seems perhaps that gold was not yields and dollar minded, uncharacteristically, running into the election. But once the election outcome and the uncertainty therein was relieved, we ended up essentially closing the disparity. And so gold ultimately did what you might have expected, which is end up lower with higher yields and a higher dollar. But again, here's the Powell crescendo, as with the dollar right here. And since then, gold has recovered smartly. So what is going to tip the scales here? Why are these things stuck? Well, so far, the news flow hasn't really told you that anything is different. It's only told you that you've run out of juice on that which was already there. Because the narrative hasn't changed, but the markets don't want to keep betting on it. They don't want to set lower lows on gold. They don't want to set higher highs on the dollar. They don't want to set higher highs on yields and lower lows on the bonds for whatever reason. Perhaps there's just nothing left to speculate on. Near term. Meanwhile, the next inflection point will be PMI data coming out of the major economies and giving us an update on those global growth dynamics, whereas we just saw the US has been such a strong outperformer. And what we see is interesting. So let's work our way backwards here and notice the composite index for the US, and as ever, these things are centered around 50, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. In the US, the composite index, which takes in both manufacturing and services, is expected to accelerate a bit. That would imply that the 12-month high for growth that we hit back in May, and where we've kind of hovered, as it were, since then, is going to get a little bit of a tick higher, not too far, but we continue to grow at the top of the range, as it were, for the past 12 months. In the case of the UK, not exactly a contraction, but things are expected to remain at even keel. 51.8 to 51.8 basically tells you the pace of growth remains the same. In the Eurozone, another month squarely at 50 after a contraction in August. Tells you we have neither growth nor expansion. We're marking time here. In Japan, similar story, marking time. A little bit on the contraction side, but basically at even. And in Australia, just a touch faster. But again, hugging the center line, hugging 50. So at face value, this looks like about the same sort of world as we've seen over the past 2 months. Strong US, anemic Europe stands still in Asia, in particular in Australia, where China is the big marginal source of demand. And of course, that demand is weak. Now, we're not going to get updates on China's numbers, but we are, of course, as we can see here, going to get updates on the Eurozone. And this is important because between the Eurozone, the US, and China, we have 58% of global GDP as of last year's numbers. So we have the three main engines of global economic growth. And of course, we can see that China remains anemic. And we'll see their November numbers over the coming days here, not this week. But we are going to get the Eurozone, and so we'll get a sense for at least what end demand is doing in two of the big growth engines. Aside from the 58% made up by those three economies, the remaining 42% are basically vendors dependent on demand from the former three. And need those three to be buying things in order for them to have growth. So let's leave China aside for a second until we get those numbers, but at least between the Eurozone and the US, what we find is that most recently, since basically the beginning of October, conditions in the Eurozone have quietly started to look a little bit better. Again, not in absolute terms. We just saw the PMIs at 50 tell us the economy is standing still, or at least the economic activity is standing still, neither accelerating nor decelerating. But surprise risk is shifting to where over the course of October, the data is surprising lower by a diminishing margin. Now, as of November, we're slightly tilted in favor of positive surprises. If we were to see a positive surprise then on the PMIs, what we would end up with is perhaps a situation that wouldn't necessarily tell us the U.S. is going to stop outperforming, but would tell us that maybe the gap is narrowing. And the story whereby the U.S. is out in front and everybody is stuck in the back is falling away, and a rethink is in the works. That might start to narrow yield differentials and give us a pop in currencies other than the U.S. dollar and push the U.S. dollar back. It might also suggest that not only are we going to have higher interest rates in the U.S., other central banks might start to rethink how much stimulus they want to do if their economic growth profiles start to look a little bit stronger versus where they've been over recent months, and we start to close some of this disparity right here, at least between the G10 and the US. Hopes for China are slimmer, but at least this gap might start to close. And that might actually end up looking like risk aversion, because higher rates globally wouldn't very much align with robust stock markets, which have ended up at their recent highs, in some measure at least, because of speculation around monetary stimulus downwind. And that might give us higher bonds, not because we're looking at some sort of a rethink that is more dovish. On the contrary, we're not, but that might just look like risk aversion, where capital leaves stocks and goes into the safety of bond markets, especially if there's fewer cuts and locking in some of these elevated yields starts looking attractive. You get lower yields and a weaker dollar, you might likewise get another leg up in gold. Maybe revisit some of these levels here. And so what we might get in the wake of these numbers isn't so much a change in the bigger story, but a turning of the speculative relief valve, where the rubber band has been stretched and now has room to snap. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio. I am going to be back here in just 30 minutes, as I am every Wednesday, for The Price of Truth with the great and powerful Victor Jones. I'll be back with Chris for the usual tomorrow, as well as for Futures Power Hour on Friday. I'll be back with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, as well as on Blue Sky at Ilya Spivak. If you're watching on YouTube, like and subscribe. Thanks very much for joining. Macro Money's back tomorrow.